So now I would like to welcome Professor Paula. Welcome, Paula.
Thanks, Tony. I trust everyone can see my slides. Just to introduce myself, I'm a professor at the University of Queensland and also at City St George's, University of London in the UK. I've been studying the insurance and reinsurance sector for a couple of decades now, the global reinsurance sector, and also protection gaps, and in particular, the types of interventions to address those protection gaps. And most recently, I'm doing a great deal of work looking at resilient housing programs in Australia. I obviously am an academic, so I do a lot of research in this area, but I also try to be practical and relevant. And indeed, I've been on a number of advisory groups and boards, including currently the OECD High-Level Advisory Board for the financial management of catastrophic risk. So that's just a little bit about me. But what I'd like to do is talk to some of the points. I think this caps nicely on some of the points made by our previous colleagues about, when we get into this situation in which risk is no longer affordable, particularly for those in a lower socioeconomic, we can do certain types of things, or we can see that governments do things. What we call these is these public-private entities, protection gap entities. We call them that because all of them are government-legislated organisations that are put together at the insurer or reinsurer level to counteract insurance being unaffordable or unavailable for some sector of the population. They are not all public-private partnerships. Some are public, some are private, but all of them are public in so much as they are government legislated. And my team and I studied 17 of these operating in 49 countries around the world. Some of them are indeed for natural hazards and for some of these kinds of problems of legacy assets and the increasingly extreme weather, but they can be for things like terrorism as well, or to make markets in countries where there isn't much insurance yet. What I'd like to talk about is the ones that are very specific to what we're talking about today and which has been brought out by previous colleagues, the problem of what we might call too much knowledge or risk-reflective pricing. So when we know that we've got a lot of assets that have been built without perhaps thinking, we've got housing stock that's been built without people thinking about changes in runoff, changes in infrastructure, changes in weather, and we've also got increasing urbanisation and pressure on housing, and alongside changes in climate, what we do see is frequent expensive damage has become a virtual certainty in some areas. And when we marry that to some of what's been said by the previous colleagues with advances in disaster risk modelling, which have been improving significantly over the last perhaps 40 years, we can say that a lot of houses that are highly exposed are being priced out of the market. Now, many of those are indeed lower socioeconomic, but not exclusively so. We also have high value assets. What we would call this is a problem in which repeated disasters give us a great deal of knowledge about those houses which are becoming uninsurable, as in not affordable or no longer offered to those properties because they no longer fit some of the kinds of curves that indeed George was speaking about. Some of the ones that you might see that have been built for this specific situation are Flood-Re in the UK or the Australian government, currently the Australian Reinsurance Pool Corporation. The cyclone pool that we've developed is a version of this, developed to do this. There are a number of these around the world. Some of them operate on the flat rate model that was talked about by my previous colleague, Max. Others operate on a risk-reflective basis. But what I want to say is that if these only subsidise price, so if all they do is create flat rate insurance, they will manage the protection gap for a period of time. But if we acknowledge that the problem is the legacy assets themselves and also a worsening climate, so more assets being built that are not resilient in the path of more extreme weather alongside existing assets that are not robust, then it's not sustainable, whether it's in the public or the private sector. So what should we be doing with these PGEs? And one of the things that I'd like to show you, we've looked at least 3 or 4 of them that are compulsory flat rate. And I'd like to show you one, which is the Swiss system. It's compulsory on both sides, which means everybody has to take it, but also the PGE has to take the risk. They can't make it unaffordable or unavailable. Under the circumstances, you have very high insurance uptake with which is affordable. This has been going for over 100 years. What it gives you is a great deal of risk knowledge about the insurance claims because every claim goes to this organisation. What this gives you is an opportunity to use it not only for insurance, but for physical resilience and adaptation. You will see Build Back Better as the most basic thing, and I think that's something that the private sector still struggles with, but you do see Flood Re try to do that. And certainly within the Swiss system, Build Back Better is a part of built into claims. Alongside that, you see integrated disaster response. So they pay for the first responses to contain disaster loss, because if you can stop the situation getting worse, you can also attain the costs of that. But I think the big differences are they're also, because they have a lot of lost knowledge over decades, is they're integrated in designing the infrastructure, so they know where the bridges go out, where the problems are. They're integrated in developing construction standards because they actually have to take the risk on all of the properties, and therefore they get a say in what will be built and how it will be built, because they have to take the risk. So they should have some sort of say in what that risk is. Alongside that, every time that there is a loss, that's integrated in developing more granular risk maps. So it's where risk knowledge and risk maps can actually be used to support risk reduction and land use planning, rather than risk knowledge and risk maps pricing people out of the market. How do we use this to change the risk? Of course, all of this, and we have written about this extensively, and I'll provide you some references, means that insurance-based risk knowledge, instead of sitting inside intellectual property and competitive kind of advantage, sits in a system of government-wide resilience, supporting government-wide resilience. So it's making insurance part of the disaster ecosystem. And what I'd like us to think about is, if we want insurance to be a source of climate adaptation, we need to move beyond any type of public or private system that will simply build back to normal in a localized area after a disaster. What we're getting there is, of course, if people get back to normal quickly after a disaster, that is good for them. That is a form of adaptation, but it's a maladaptation, because those properties have already shown that they're not suitable. And what we need is to move to some kind of climate adaptation, where we're using the insurance system and any claims and any knowledge to reconfigure the wider system and our longer term resilience. And this is where we see these kinds of protection gap entities as one of the tools in the service of societal protection. And if you'd like to know more about that, we wrote this book about it. I am not trying to sell the book. I got a grant from the European Union so that you can have it for free. Please feel free to scan the barcode there and you can have the e-copy for free. We're very grateful to be able to provide that to people. And I hope that that's given you a few thoughts to bring together some of what my former colleagues have said. I appreciate the opportunity to talk to you.